Are banks about to boom? Leslie Picker explains why bank stocks are hitting new highs and breaks down how regulatory reforms could free up billions for buybacks and dividends, and what investors should watch
Up
next.
these names on just a slew of indications that the regulatory chokehold that many executives have been complaining about for years is attenuating. Friday's easier than usual stress test means the banking system is poised to return more capital to shareholders through dividend hikes and buybacks. Those will be announced tomorrow after the close. As analyst Mike Mayo put it in a note this morning, quote, the Fed stress test is a clear demarcation that regulation is becoming less onerous, less volatile, and more transparent. Mayo says the test freed up an estimated $100 billion in capital, which is enough for more loans, $1 trillion worth, theoretically, deals and buybacks. Now, even though this test was the first overseen by new Fed Vice Chair for Supervision, Michelle Bowman, it was actually designed before she took that seat. Still, the hypothetical scenario that they tested was seen as the easiest in years. And that's because the banks took the test at a better starting point from a fundamental standpoint. But there were also very low trading losses reflected in the test, which may simply reflect auspicious client positioning on the day of the shock that they were tested for, according to JP Morgan's research. Wells Fargo, Goldman seeming to benefit the most from this, according to JP Morgan, with Goldman experiencing almost zero trading losses in the test. Still, the street is taking that element as a potential anomaly this year. But on top of the easier stress tests, the Fed is moving forward on a proposal that will loosen another capital requirement, the supplementary leverage ratio, and that is furthering investor optimism around just this overarching theme of capital freedom, essentially, guys.
I love that you brought it there because I wanted to ask about the SLR. And Leslie, exactly what the process is from here. So is it a kind of given that this is going to change? Do we know how much it's going to change by? I mean, analysts, when you see Mike Mayo talking there about extra money to return to shareholders, are they factoring this SLR change in yet, or is it a sort of extra benefit to come if it all gets confirmed by the end of the year or whenever it might be?
Sure. So they go through a comment process from here, but it does appear that while it's not a ubiquitous agreement that this needs to be changed, there were essentially two dissenters that didn't like this idea. They thought that it left the system more vulnerable to systemic risk. But basically, after that comment period goes through, then I do believe that most analysts in the street expect it to take effect, and it would essentially cut in half the amount of extra capital that these banks need to hold against their entire balance sheet. This is seen as essentially a backstop against the more risk-weighted capital that we see from the stress tests and other elements as well. They basically had to hold additional capital against their entire balance sheet, regardless of risk. So they're holding capital against things like treasuries and other areas that are perceived to be risk-free. So that was something that has been perceived as a need for reform for a while now, given that we've seen some stress in the treasury markets, and banks say that that makes them less inclined to intervene, since holding treasury is essentially a knock on the amount of capital that they need to hold. So that's something to watch. Additionally, as it pertains to the stress tests, there's a process in place to essentially average the results over 2 years, which people think would create less volatility there.
All I know is Michelle Bowman, Secretary Bessent. I mean, this is a much better environment for the banks on the deregulatory front. Thank you, Leslie. Leslie Picker.